Hello, everyone. In this international finance lesson, I will discuss managing FX exposure. We will begin with a discussion of the types of foreign currency exposure. But before we do that, let's clarify what is risk and what is exposure. Risk refers to the degree of uncertainty or possibility of financial loss. Therefore, foreign currency risk refers to the risk associated with random changes in exchange rates. Exposure, on the other hand, refers to the amount of the possible financial loss as a result of the risk. So now that we've clarified what is risk and what is exposure, let's delve into the types of foreign currency exposure. Generally, we can classify foreign currency exposures into three types. The first is transaction exposure. Transaction exposure is the sensitivity of realized domestic currency values of firms' contractual cash flows denominated in foreign currencies to unexpected changes in exchange rates. And let's be clear that the firm's contractual cash flows are referring to accounts receivables or payables in foreign currency. Again, the firm's contractual cash flows referred to here is accounts receivables or payables denominated in foreign currencies. Second type of foreign currency exposure is economic exposure. Economic exposure is the extent to which the value of the firm may be affected by unanticipated changes in the exchange rates. And third is translation exposure, which can also be referred to as accounting exposure. And translation exposure is the potential that the firm's consolidated financial statements can be affected by changes in the exchange rates. And this is because when you have a parent company with foreign subsidiaries, implying that the parent company has ownership in some foreign companies, right? Now, those foreign companies would have their financial statements prepared, and it will be in foreign currency. So when the parent company prepares its financial statements, it will need to consolidate its financials with those of its ownership in these foreign subsidiaries. And let's remember those ownership interests will be in the foreign currency. So those foreign currency ownerships will need to be converted into the parent company's currency or its domestic currency. And in doing that conversion, the amounts could be affected by changes in exchange rates, and that is translation exposure. Let's now discuss hedging of transaction exposure with financial contracts. But before we delve into that, let's remind ourselves that a firm is subject to transaction exposure when it faces contractual cash flows that are fixed in foreign currencies. Now, transaction exposure can be hedged with operational strategies or financial contracts. And at this point, we focus on hedging with financial contracts. So focusing on hedging with financial contracts, we can hedge transaction exposure such as foreign currency receivables and foreign currency payables with financial contracts such as forward contracts, money market instruments, options, and swaps. So let's consider the forward market hedge. And And we begin that discussion by looking at foreign currency receivable. So using a forward hedge for a foreign currency receivable. Now, if a firm has a foreign currency receivable, it can hedge the exposure with a short position on a forward contract. A short position means entering into a contract to sell the foreign currency to be received in the future at a specified rate. Therefore, effectively, the firm has locked in the rate it will convert the foreign currency receivable. Let's consider a specific example of such a hedge. That's a forward hedge of a foreign currency receivable. Suppose a Canadian company has £1 million receivable from a UK customer. Again, £1 million receivable from a UK customer. Now, let's assume that the Canadian company enters into a forward market hedge for this account receivable. Let's assume that the forward rate is 1.46 Canadian dollars for £1. So £1 is exchangeable for 1.46 Canadian dollars, and that's the forward rate. Now, if on the maturity date of the forward contract, the spot rate that's in the spot market, if the spot rate turns out to be 1.40 Canadian dollars for £1, let's take note that in that case, the spot rate is less than the forward rate because the forward rate was 1.46 Canadian dollars for £1. Now, the implication of this is that the Canadian company would have received 1.4 million Canadian dollars instead of 1.46 million Canadian dollars had it not entered into the forward contract. So as a result of the forward contract, the Canadian company would receive in 1.46 million Canadian dollars rather than 1.4 million Canadian dollars. Now, as a result of that, we can see that there's a gain, and this gain can be computed as follows: the forward rate minus the spot rate, and then of course multiplied by the £1 million. Again, the forward rate 1.46 minus the spot rate 1.40 multiplied by £1 million will convert the gain into Canadian dollars, and that is 60,000 Canadian dollars. So with the consideration of the foreign currency receivable that we've just covered, we can now move on to forward hedge for a foreign currency payable. Now, if a firm has a foreign currency payable, it can hedge the exposure with a long position on a forward contract. A long position means entering into a contract to buy foreign currency at a specified rate in the future. Therefore, effectively, the firm has locked in the rate it will buy foreign currency that will be used to settle the foreign currency payable. We now turn our attention to money market hedge. And we first look at the money market hedge for a foreign currency receivable. A firm may borrow in foreign currency against its foreign currency receivables, and by so doing, it will match its assets and liabilities in the same currency. So for example, a US firm can eliminate the exchange exposure arising from a UK sale by first borrowing in pounds, then converting the loan proceeds into dollars, which then can be invested at the dollar interest rate. On the maturity of the loan, the US firm is going to use the pound receivable to pay off the pound loan. Now, if the US firm borrows a particular pound amount so that the maturity value of this loan becomes exactly equal to the pound receivable from the UK sale, the US firm's net pound exposure is reduced to 0. Now, considering the money market hedge of a foreign currency receivable, that will be on the flip side. So if a firm has a foreign currency payable, again, if a firm has a foreign currency payable, now we're looking at the money market hedge of a foreign currency payable. So on the flip side, if a firm has a foreign currency payable, it can borrow in the domestic currency and use it to buy foreign currency today. Again, it can borrow in the domestic currency and use it to buy foreign currency today, and then invest the foreign currency abroad against the foreign currency payable. And by so doing, the company would have used a money market hedge to cover its foreign currency payable exposure. Now let's look at the use of options to hedge transaction exposure. Now, for a foreign currency receivable, a put option can be used to hedge the exposure. Note that the put option gives the right, but not obligation, to sell the foreign currency receivable at a specified price in the future. And for a foreign currency payable, a call option can be used to hedge the exposure. Note that the call option gives the right, but not obligation, to buy foreign currency at a specified price in the future that will be used to settle the foreign currency payable. Let's now compare currency futures with currency forwards. A firm could use a currency futures contract rather than a currency forward contract for hedging purposes. A futures contract is not as suitable as a forward contract for hedging purposes for two reasons. Unlike the forward contract that are tailor-made to the firm's specific needs, again, a forward contract will be tailor-made to the firm's specific needs. Futures contracts are standardized instruments in terms of contract size and delivery date. Therefore, in most cases, a firm can only hedge approximately with a future contract, all right? Again, in most cases, a firm can only hedge approximately with futures. Now, due to the marking to market for futures contracts, there are interim cash flows prior to maturity of the futures contract, and this may need to be invested at uncertain interest rates. Again, this makes exact hedging with futures more difficult. Let's now consider currency options. A currency option provides a right, but not an obligation to buy or sell a currency. And currency options offer some advantages. For example, it provides a flexible hedge against exchange exposure. It limits the downside risk while preserving the upside potential. And currency options can provide an effective hedge against what might be called contingent exposure. And contingent exposure is a risk due to uncertain situations in which a firm does not know if it will face exchange risk exposure in the future. For example, if a Canadian company is bidding on a project in Europe, and if the bid is accepted, which will be known in 3 months' time, the Canadian company is going to receive 50 million euros to initiate the project. Since the Canadian company may or may not face exchange exposure, it faces a typical contingent exposure situation. Note that it is difficult to manage contingent exposure using traditional hedging tools like forward contracts. But an alternative is for the Canadian company to buy a put option on the 50 million euros. At this point, let's turn our attention to hedging transaction exposure with operational strategies. Transaction exposure can be hedged using operational techniques such as the choice of the invoice currency and lead lag strategy. Let's first consider hedging with invoice in currency, or hedging through invoice currency. Now, hedging through invoice currency is an operational strategy that allows a firm to shift, share, or diversify foreign exchange risk by appropriately choosing the currency of invoice. So, for example, if a Canadian company invoices 150 million Canadian dollars to its UK customer, rather than the pound equivalent, which is 100 million pounds, the implication will be that it does not face exchange exposure anymore. Though the exchange exposure has not disappeared, it has been rather shifted to the British importer. Let's now consider hedging through the lead lag strategy. The lead lag strategy reduces transaction exposure by paying or collecting foreign financial obligations early. That is the lead strategy, or late. That's the lag strategy, depending on whether the currency is hard or soft. And to be clear, a hard currency, or the currency, is hard when it's stable, and it's soft when it's unstable. Now, there are challenges associated with the lead lag strategy. If we assume the Canadian company would like its British customer to prepay 100 million pounds, remember the UK customer needs to pay 100 million pounds for the sale. We can also assume that the British customer would have no incentive to do so unless it received a substantial discount to compensate for the prepayment. So the lead lag strategy could run into challenges. Again, if we assume that the Canadian company would prefer that the British customer prepays, on the flip side, a British customer would also not have any incentive to prepay unless you offer them a substantial discount to compensate for the prepayment. Also, pushing the British customer to prepay may hurt future sales efforts by the Canadian company. And let's note that to the extent the original invoice price incorporated the expected depreciation of the pound, the Canadian company is already partially protected against depreciation of the pound. Let's now discuss strategies used by firms to hedge FX transaction exposure. Now, it's been shown in a study that the FX forward contract is the most popular financial instrument that is used to manage FX risk. And indeed, based off on a study of 1,100 corporate risk managers around the world, the study indicated that 64% of firms use forward contracts. Now, as far as operational techniques is concerned, pricing strategies are the most commonly used operational hedging method, with 55% of firms reporting that they use that to deal with FX risk. At this point, we will shift our discussion from transaction exposure to economic exposure. Let's note that changes in exchange rates can affect not only firms that are directly engaged in international trade, but also purely domestic firms. Exchange rate changes can systematically affect the value of the firm by altering its competitive position and influencing its operating cash flows, and by affecting the domestic currency values of its assets and liabilities. So how do we measure economic exposure? Before we delve into the measurement of economic exposure, let's one more time clarify what is currency risk and what is currency exposure. So currency risk represents the random changes in exchange rates or the uncertainty, all right, around the random changes in exchange rates. And currency exposure measures what is at risk. So unlike transaction exposure, that is well defined, economic exposure needs to be estimated. Exposure to currency risk can be properly measured by the sensitivity of the future home currency values of the firm's assets and liabilities to random changes in exchange rates, and also by the sensitivity of the firm's operating cash flows to random changes in exchange rates. Let's at this point illustrate operating exposure. And before we do that, let's clarify that under economic exposure, we have operating exposure being the extent to which the firm's operating cash flows will be affected by random changes in the exchange rates. There is also asset exposure, which is the effect of the domestic currency values of the assets and liabilities. And this will be how the exchange rate affects the domestic currency values of a firm's assets and liabilities. And that's asset exposure. At this point, our focus is on operating exposure, which again is under the umbrella of economic exposure, as well as asset exposure. Both of them are under economic exposure. And operating exposure, again, is the extent to which a firm's operating cash flows will be affected by random changes in the exchange rates. So let's be clear that operating exposure is not readily measurable, since it depends on the effect of random exchange rate changes on the firm's competitive position. Now, in many cases, operating exposure may account for a larger portion of a firm's total exposure than the contractual exposures. Now, suppose a US computer company has a wholly owned British subsidiary. Let's refer to that as Bedford Computers. And the British subsidiary manufactures and sells PCs in the UK market. If Bedford Computers, that's the British subsidiary, imports microprocessors from Intel, and Intel sells them to Bedford Computers at $394 per unit. So each microprocessor from Intel is purchased by Bedford Computers at $394 per unit. Now, at the exchange rate of $1.58 to a pound, let's assume that's the exchange rate. The implication is that each Intel microprocessor would cost $249.38, and we'll get that by dividing $394 by the exchange rate, 1.58, and we'll get 249.38 pounds as the cost in pounds of one microprocessor. Now, the pound price of the imported input, which is the microprocessor, will change as the exchange rate changes, which in turn can affect the selling price in the UK. Now, Bedford Computers hires British workers and sources all the other inputs locally. Let's assume that. And let's also assume that Bedford Computers faces a 45% income tax rate in the UK. Continuing with our illustration of operating exposure, we'll consider the possible effect of a depreciation of the pound on the projected dollar operating cash flow of Bedford Computers. So assume the pound depreciates from $1.58 to the pound to $1.45 to the pound. The dollar operating cash flow may change following a pound depreciation due to the following. One is the competitive effect. A pound depreciation alters the firm's competitive position in the marketplace and affects the operating cash flow in pounds. Second is the conversion effect. A given operating cash flow in pounds will be converted into a lower dollar amount after the pound depreciation. So what are the factors that determine operating exposure? A firm has operating exposure that cannot be readily determined from the firm's accounting statements, unlike transaction exposure. Again, operating exposure for a firm cannot be readily determined from the firm's accounting statements, unlike transaction exposure. And let's note that a firm's operating exposure is determined by the structure of the markets in which the firm sources its inputs, such as labor and materials, and sells its products also. The firm's operating exposure is also determined by the firm's ability to mitigate the effect of exchange rate changes by adjusting its markets, product mix, and sourcing. Continuing our discussion of the determinants of operating exposure, let's note that a firm is usually subject to high degrees of operating exposure when either its cost or its price is sensitive to exchange rate changes. And the extent to which a firm is subject to operating exposure depends on the firm's ability to stabilize cash flows in the face of exchange rate changes. Now, when both the cost and the price are sensitive or insensitive to exchange rate changes, the firm would have no major operating exposure. So how can firms manage operating exposure? Before we delve into that, let's clarify that the objective of managing operating exposure is to stabilize cash flows in the face of fluctuating exchange rates. Now, firms may use the following strategies for managing operating exposure, and we have 5 strategies. The first is selecting low-cost production sites. Now, when the domestic currency is strong or expected to become strong, a firm may choose to locate production facilities in a foreign country where costs are low. Low costs may be due to either the undervalued currency or underpriced factors of production. The firm may choose to establish and maintain production facilities in multiple countries to deal with the effect of exchange rate changes. So for example, Nissan has manufacturing facilities in the US, in the UK, and Mexico, as well as Japan. Second strategy for managing operating exposure we'll look at is flexible sourcing policy. Flexible sourcing policy is a strategy for managing operating exposure that involves sourcing from areas where input costs are low. Even if a firm has manufacturing facilities only in the domestic country, it can substantially lessen the effect of exchange rate changes by sourcing from where input costs are low. So for example, in the early 1980s, when the dollar was very strong against most major currencies, US multinational firms often purchased materials and components from low-cost foreign suppliers. Third strategy for managing operating exposure we will look at is diversification of the market. Diversifying the market for a firm's products is another way to manage exchange exposure. So for example, if GE is selling power generators in Mexico and Germany, reduced sales in Mexico could be compensated by increased sales in Germany. Now let's take note that the reduced sales in Mexico will be due to the dollar appreciation against the Mexican peso. So that will cause reduced sales in Mexico. And then if you have the dollar depreciation against the euro, that would compensate the reduced sales in Mexico because there'll be increased sales in Germany as a result of the dollar depreciation against the euro, if that were the case. The fourth strategy for managing operating exposure we will look at is product differentiation and R&D efforts. Investment in research and development, R&D, can allow a firm to maintain and strengthen its competitive position in the face of adverse exchange rate movements. Successful R&D allows a firm to cut costs and enhance productivity, and also to introduce new and unique products for which competitors offer no substitutes. And moving on to the fifth strategy for managing operating exposure, we will now consider financial hedging. Financial hedging can be used to stabilize a firm's cash flows. And let's be clear again that financial hedging refers to hedging exchange risk exposure using financial contracts such as currency forward and option contracts. Now, if operational strategies which involve redeployment of resources are costly or impractical, financial contracts can provide a firm with a flexible and economic way of dealing with exchange exposure. We will now discuss measuring asset exposure, and we'll consider a US firm that owns an asset in the UK. So from the perspective of the US firm that owns an asset in the UK, the exposure can be measured by the coefficient B in the regression of the dollar value P of the British asset on the dollar pound exchange rate S. So we'll have the regression equation expressed as P equals A plus B multiplied by S, where A is the regression coefficient. A is the regression constant. Again, A is the regression constant. So we can consider the regression constant as the intercept, all right? That's like the y-intercept on the vertical axis when you have the graph where it intersects. So that's the regression constant. And B is rather the regression coefficient. And that measures the sensitivity of the dollar value of the asset P to the exchange rate S. Again, B is the regression coefficient, right? Because you can see B multiplies S. So it's the coefficient of the independent variable S. B multiplies S. So that's the coefficient, right? And the coefficient is the indication, it's the measure of the relationship between S, that's the exchange rate, and the asset value P, right? And it is measuring the sensitivity of the dollar value of the asset, which is P, to the exchange rate S. Now, the regression coefficient B is calculated by dividing the covariance of P and S. And that's the dependent and independent variable in the regression, all right? So again, the regression coefficient B is calculated by dividing the covariance of the independent and dependent variable by the variance of the independent variable. And let's take note, the independent variable here is the exchange rate S. We use the independent variable to predict the dependent variable P. So covariance of P and S divided by the variance of the exchange rate S. Now, covariance measures the direction of the linear relationship between two variables generally. So a positive covariance indicates that as S, the exchange rate increases, P, the asset value, that's the dollar asset value, will also tend to increase. And a negative covariance indicates that as the exchange rate S increases, the asset value P will tend to decrease. Now, for the variance, that's the variance of the exchange rate, that's the variance of S. That represents the variance of the independent variable. Remember, the independent variable is S. So variance of S measures the spread or variability of the exchange rate data. And typically, it will be the spread or variability around the average exchange rate. The average is the expected value. So the variability of the exchange rates around the average exchange rate will be the variance of the exchange rate. Now, continuing with our interpretation of the regression coefficient, let's declare that B, the regression coefficient, can also be described as representing the slope of the regression line. So it indicates how much the asset value P, which is the dependent variable, is expected to change for every 1 unit change in the exchange rate S. And the exchange rate S is the independent variable. Now, the sign of the B coefficient, whether it's positive or negative, will indicate the direction of the relationship between asset value P and exchange rate S. A positive coefficient means that as the exchange rate increases, the asset value P would also increase. And a negative coefficient means that as the exchange rate increases, the asset value P would decrease. All right, so let's be clear again. A negative coefficient means that as the exchange rate S increases, the asset value P will tend to decrease. Now, finally, let's also note that once we know the magnitude of the exposure B, once we're able to calculate B and we know what it is, a firm can hedge that exposure, that amount of exposure, using a forward contract. And by doing so, the firm can eliminate the risk or volatility of the asset value. All right. Let's continue our discussion of the measurement of asset exposure by looking at the formulas, especially the variance and covariance formulas, and clarify the calculation. Now, in calculating the variance and covariance, the expected values are included in the formulas. So, for example, we have the expected value of the asset. That's E of P. That's E in brackets P. That's the expected value. Now, the expected value is simply the average of that value. So the average of the asset value, right? Now, we tend to have different scenarios considered for the asset value and different scenarios considered for the exchange rate. So for each scenario, you have a probability, a likelihood of that scenario occurring. So that will be the probability for that scenario. So if you have n number of scenarios, whether it's 2 or 3 or 4 or 5, you're going to have 4 or 5 or 2 or 3, the n number of probabilities. Now, let's take note that all those probabilities for the different scenarios, for example, for the asset value, the different probabilities should add up to 1 or 100%. Okay, so therefore, to calculate the expected value of P, we simply multiply the probability for each scenario of P by the asset value specific to that scenario. And if we have n number of scenarios, we'll do that multiplication of probability by that asset value and then add up. And that gives us the average. Similarly, for the average of the exchange rate, which is also known as the expected value of the exchange rate, E into bracket S, we'll consider the various scenarios possible for the exchange rate to be. And for each of these scenarios, it comes with its probability. So we multiply the probability by the exchange rate predicted for that scenario. And once we multiply that, and we do that multiplication for each scenario's probability and the exchange rate predicted for that scenario, we add up and we get the expected exchange rate, which is the average exchange rate. Now that we have the expected asset value, E of P, and we have the expected exchange rate, E of S, we can calculate the variances. And the variances are simply the deviations from the expected values that is squared. Let's remember that you always square the deviation. So the deviation is for each data point, for each possible point, or for each data point of the asset value, you subtract the expected value from it, right? So once you subtract, you get a deviation. You square it. By squaring it, if you have a negative or positive deviation, all will become positive. And then multiply each calculation of the deviation squared by its corresponding probability. And then after that, we add, and that gives us the variance for P. And if we do the same for S, we'll get a variance for S. And with the variance for S calculation, we simply subtract the expected value of S from each possible exchange rate. And once we do that subtraction, we get a deviation, and then we square it, and then multiply by its corresponding probability. We do that for the different scenarios possible for the exchange rate, add all of that up, and then we get a variance of the exchange rate. Now, as far as the covariance of the asset value and the exchange rate, which measures the relationship between the two, rather than calculating the deviation and squaring, for each scenario, we calculate the deviation for the asset value for the first scenario, deviation for the exchange rate for the same first scenario, multiply the deviations, and then multiply by the probability of that scenario occurring. We do that for all the scenarios possible. And then we add. And once we add, we get the covariance of P and S. Again, let's remind ourselves that covariance measures the direction of the linear relationship between P and S in this case. A positive covariance indicates that as S increases, P also tends to increase. And a negative covariance indicates that as S increases, P will tend to decrease. Continuing with our discussion of measuring asset exposure, let's note that the variability or variance or uncertainty of the asset value in dollars can be expressed in the equation variance of P equals B squared multiplied by variance of S plus V of E, that's variance of E, where variance of P equals the variance of the asset value for the unhedged asset position. B squared multiplied by variance of S represents the variance in the asset value associated with the exchange rate volatility. And variance of E equals the variance in the asset value remaining after hedging the exchange rate exposure. Note that the variance remaining is typically much lower than B squared variance S. And again, B squared variance S is the variance in the asset value associated with the exchange rate volatility. And let's remind ourselves that once we've calculated B, that's the exposure, once we've calculated it and we know the amount, a firm can hedge the exposure B using a forward contract. And by doing so, we can eliminate the volatility of the asset value that is due to the exchange rate volatility. Now, when the exchange rate exposure is hedged, most of the variability or uncertainty is eliminated, and we are left with a small variance E, V of E, which is the variance of the asset value after hedging the hedged position. And we can indeed calculate variance of E. That's the variability or variance that remains, okay? And how do we calculate that? We can calculate it by calculating variance of P and subtracting B squared multiplied by variance of S. All right, so we can calculate the variance remaining. That's the variance in the asset value remaining after hedging the exchange rate exposure. We can calculate V of E, again, by taking variance of P minus B squared multiplied by variance of S. And that brings us to the end of our discussion of managing FX exposure. I hope you've enjoyed this lesson, and I look forward to delving into other international finance topics with you in subsequent lessons.